Good morning, everyone. Welcome to this webinar presented by ETM Analytics, George Klinos, and by TreasuryONE. George, we just had a quick little brief chat beforehand, and you said there's a lot happening, but the markets are not discounting it, and we can definitely see it. There's been a lot of noise about interest rates, about tariffs. Even Jerome Powell said the tariff is being paid actually by the company between the exporter and the consumer. He didn't say this stagflation, but he said they've got a tricky situation where they've got inflation is probably going to creep up, but growth and jobs that's going to go down. That's nothing else than stagflation. They called it I think he called it a tricky situation or difficult situation they find themselves in. That's from the US perspective. The Reserve Bank yesterday did what the market expected. They kept interest rates unchanged, although their quarterly projection models is pricing in more cuts, but they did have a concern about inflation again. So inflation still remains a little bit of a problem worldwide. We've seen Bank of England keep interest rates unchanged, but now we've seen the rand just sort of being stuck here at lower ranges. We've been advocating for a stronger rand, not because of the rand doing anything right, but because of the dollar being weak. So with all that being said, George, I want to hand over to you and just to paint us a little bit of a picture of where we are currently standing, what we're seeing, and if all that we've said in the past 2, 3, 4 months is still holding water, or are we seeing some changes happening?
Yeah, thank you, Vichard. It's a tricky time to be a central bank governor at the moment, not just because of all the points you mentioned, but there's another on top of all of that, and that's the fiscal picture. It's a fiscal picture that has deteriorated quite a lot since COVID, and we only now are the chickens coming home to roost. So, we've spoken about this before, but many central banks around the world have cut their purchasing of U.S. treasuries and bonds. In other words, they've stopped quantitative easing. They went into quantitative tightening, where they were physically selling those bonds back into the market and trying to shrink their balance sheets. But the minute they've done that, they've exposed the fiscal positions of many countries around the world, which has made life a little bit tricky for the central banks, because this is what's happening. And much to the frustration of someone like Donald Trump, the Fed has been reducing interest rates, but it hasn't had much of an impact on the bond market. So let me take you through some of the considerations that the central banks have, because a lot of it is not making much sense at the moment until you start to overlay things like AI, until you start to overlay the central bank behavior historically and where we're at the moment. So let's start off with my favorite chart, and that's the dollar liquidity cycle, just to put everybody in the picture as to where we stand. By rights, when you see a chart like this, you should be screaming recession. You should be talking about a major collapse in financial markets. You should be talking about vulnerabilities all over the place, heightened risk perceptions. You should be talking about a lot of danger signals coming through. Now, we know that some of the reason why this chart is dropping off like it is because of base factors. And if you look back to 2020 on the graph, you'll see that the graph went vertically upwards. That was when the Federal Reserve, along with many other central banks, pumped a huge amount of liquidity into the global economy through quantitative easing. They did that to support the economy at the time because, well, the authorities effectively stopped the global economy. So the global economy stopped. They pumped up, they pumped in a huge amount of liquidity to try and keep asset prices from collapsing. So they kept asset prices well supported. And that started the birth of a quite strong move in stock markets to recover from the COVID crash. So they recovered quite strongly, and that momentum just seems to have gone all the way through. So we've got the situation, and ordinarily you would think to yourself, well, this is a danger signal. If I shift through to the next chart, you'd see another danger signal. So you'd see a recession indicator, which is effectively the leading indicator versus the coincident indicator. And typically when you see a ratio between the two drop off as sharply as you've seen, as in the chart on the left, you would expect to see recessions. If you have a look through the history of this chart, and it goes back quite a long way, you will notice that almost every time that this ratio has dipped quite sharply, we've gone into recession. And yet this time, things appear to be a little bit different. If I have a look at the chart on the right, which is exactly the same blue chart as you've got on the left, except this time I overlaid a 3-year change in the S&P 500. What you'll see right towards the end here is that despite this blue chart heading sharply lower, you see that your stock markets have just been going from record to record, and that the 3-year change in the stock market has actually been extremely impressive. There's been some amazing performance that's coming out of global stock markets. Now, the question to ask is whether or not the stock markets have it wrong, or whether it is the leading indicator that's the problem. So why I say that is because the leading indicator is very much driven by some sentiment-related data. And that sentiment-related data prices in a whole bunch of fears that we've seen since the beginning of the year, whether that be the effects of quantitative tightening, whether it be the effects of the tariffs, whether it be the effects of heightened inflation that the central banks can't get to grips over, whether it be that the central banks are keeping interest rates at mildly restrictive levels, even though they've brought them down. They're still at best neutral. None of them are particularly expansive at that point. So there are a few reasons that you would fear the future and believe that there could be a major correction to come, and yet stock markets aren't showing it. Stock markets are remaining elevated. Equally, when you have a look at the leading indicator versus GDP growth, you'll find that that leading indicator has been negative now for at least a couple of years. So that's the orange line. And typically, when you see the orange line dipping like that, historically, when you've seen it dip to these sorts of levels, it has coincided with recession every single time. Except that this time, GDP growth has remained impressively robust. It's just remained buoyant and at levels that many didn't anticipate. So everybody's anticipating the slowdown, and we've been talking about the risk of a slowdown for a couple of years now, and the slowdown just doesn't seem to be materializing. The traditional indicators that typically point to a slowdown just don't seem to be holding as much weight and value as they used to historically. One of the big reasons why we think that has been the case is because through the pandemic, and we still have to go back to the pandemic because there are the effects of much of what was done at that stage still unfolding to this day. Back during the pandemic, there was a huge amount of liquidity pumped in, as we said. That went towards funding the government. The government then used that to support households and businesses. And in so doing, what they did was they built up a tremendous amount of what we called excess savings. Those excess savings rose to a level of almost $2.25 trillion. That was back in 2021. That is a colossal amount of money. So out of the $5 trillion that the Fed printed up, just over $2 trillion of that went into household and private sector excess savings, which is an incredible amount of money. And you can see from 2021 onwards, the private sector just drew down on that money to the point where we're at right now. So what am I effectively saying? Well, I'm effectively saying that at least one of the reasons why GDP growth has held up as well as it has is because consumption has held up pretty well in the US throughout this time. And one of the big reasons has been this excess savings that got drawn down through the course of time. The other big impact that's come along at just about the right time, if you like, in 2024, has been the proliferation of artificial intelligence. Now, if you have a look at the Stanford Institute of Human-Centered Artificial Intelligence Center, so what they've effectively done is monitored the amount of investment that takes place in artificial intelligence. And you'll see from the chart on the left that as of 2024, there was 150 billion. Let me tell you that this chart now will look parabolic. If when we get the 2025 data, which will be at the end of this year, that figure will have risen to at least double, but probably a lot more than double this amount. Why do I say that? Well, if you paid attention to the news wires over the past week, you will have seen that Oracle made a $300 billion deal with OpenAI for the build out of technology related to artificial intelligence. That's just one company. I can assure you that there are many companies around the world that are investing very heavily into artificial intelligence. We do know from the chart on the right that there's adoption rates of artificial intelligence are increasing at a very rapid rate. And you can see where we started off 2024 with an average artificial intelligence adoption rate of just under 7%. We now almost double that in a year. So the adoption rates have doubled in a year, and we expect that to explode through 2026 and into 2027. So as that comes through, two things happen. The one thing that happens is at least one of the subcomponents to the leading indicators, being the labor market conditions and future labor market conditions, potentially distorts the leading indicators data. And why do I say that? Well, because as companies adopt artificial intelligence and boost their efficiencies and productivity, they can do without a workforce. So they are laying off workers. At the same time, they are still keeping their productivity and efficiency as high, if not higher. And this is the interesting dilemma that many of these central banks are now facing. Ordinarily, you would expect some sort of inflation dynamics to unfold in a cyclical downturn, except the cyclical downturn isn't materializing as anticipated. Now, it may be that the artificial intelligence theme is a little overblown at this moment, and we're just reading too much into it. But there is evidence that is starting to come through that a lot of these corporates on Wall Street and elsewhere are able to maintain their strong earnings potential because they are deploying artificial intelligence and extracting greater efficiencies out of their processes. There was something else that Vichard mentioned in his precursor to my presentation, and that's he indicated that inflation inflation was remaining buoyant, but that central banks were a little bit confused about how to handle all of this. Well, the reality for a central bank is that they can only deal with the data that they've got, except that artificial intelligence is throwing that into question as well. I've read a couple of papers from academic institutions. One academic institution believes that initially inflation might actually rise, despite the fact that efficiencies are coming through. And that's because the demand for AI is going to cause such shortages on a range of different products, from chips to infrastructure to computer type equipment, that you will start to see the disinflation that's very typical of those industries turn into inflation before the world adjusts to be able to supply all of the needs effectively, and whereafter inflation can come back down again. So this AI environment that we're in right now is causing quite a lot of dislocation and creating quite a bit of uncertainty. How do you play this? Well, it's quite a tricky one. You've got to just monitor data like this, and what we will be doing and what we're in the process of doing. So the next time we have this presentation, I hope to show you some interesting charts on AI and productivity, and we're trying to see whether there's a correlation between these AI adoption rates and productivity, such that we could explain this weird phenomenon where we see labor market data pointing to a recession, yet the stock market keeps going from record to record. And speaking of the labor market data, it isn't looking particularly good.
George, can I quickly interrupt you? There's a question that popped up. I just want to quickly get to it. It says,
yes,
because I don't want to interrupt on the AI story, but you spoke about the leading indicators just about a slide 2 and the possible market correction. So one of the questions that Philip asked is, what is the long-term view on the gold price? It's run unbelievably hard and concerned it's not sustainable.
Yeah, I'm going to get to the gold price in a bit. So if you'll permit me to just run through the next couple of slides, we'll touch on that, and I'll try and answer that question as best I can. So just quickly on this chart, we don't have to dwell on them too long, but you've got the situation where your downward revisions to your labor market have been extreme. Every time we've had such downward revisions, and these are the largest on record, you should see a recession, yet recession not here. The chart on the left, you're having a look at job openings versus the number of unemployed, and they're just about to cross over. Typically, another indicator of recession, yet recession is not here. And then you've got the central banks that are seeing these indicators of the labor markets coming down as they are. And so they have responded. And many of them have responded by reducing interest rates, except that we have a problem here. Because if you have a look at this chart, you'll find that the central banks, and just look at the blue, which is the ECB, for example. The ECB has been cutting rates. It's cut more than any other of the major central banks. It has cut rates very aggressively. And look at what's happened to their 30-year bond yields. Their 30-year bond yields have gone even higher. Now, this is where it becomes problematic for the central banks. They're trying to create easier monetary policy. They're trying to loosen the reins and allow the economy to rebuild a fresh credit cycle, except that the fiscal situation in many of these countries is so bad that interest rates are actually going higher. In other words, the fiscal risk is more than outweighing what the central banks are doing. And the same thing is happening in the Fed. The same thing is happening with the Bank of England. So you even with the best of intentions, the central banks are reducing interest rates now. We saw the Fed reduce earlier this week. And still the BOE has been reducing, even though they didn't move this time. You've had all of these movements in central banks, and yet the conditions for borrowing in these economies that benchmark so heavily off these bond yield curves and these bond market rates has not come through. So there's a problem building there, and that's despite the fact that we've got a lower interest rate bias almost across the world, save for two countries, being Japan and Brazil. Save for those two countries, just about every other country in the world is reducing rates, and they're reducing rates for obviously the points that I've made. So where does that leave us with central bank policy? Well, the one thing that we think is potentially going to creep back into the picture in the not too distant future, I don't think it's imminent, but through the course of the next year, it's not something I would write off, and that's the possibility that central banks default back towards quantitative easing. And why do I say that? Well, it's to try and regain some control over those longer-term bond yields. There's no point in cutting interest rates if your bond yields are just rising all the time. You need those bond yields to come down such that all that benchmarks against those bond yields, like home loans, like structured loans for M&A acquisitions, et cetera, all start to benchmark against bond yields that are progressively declining rather than rising as they're doing right now. So the chart on the right just tells us that we are right at the end of this quantitative tightening phase. I think most central banks are going to stop it. The Fed has reduced its quantitative tightening quite significantly. The Bank of England indicated that it would just about stop its quantitative tightening. And so we think that the next step from here is some neutrality for a little while before we start heading back into this phase of quantitative easing, where the central banks are actively buying up bonds again. So where does that leave us with the dollar? Because this is now an interesting question, right? Well, as you can see from this chart, it's still extremely overvalued. It has come off, and a lot of people tend to focus on the dollar and say, oh, but the dollar's weak, the dollar's come off, it's not what it used to be. Well, let me tell you, the dollar can still correct another 10%, and then still only back to neutral. So there's a long way to go for the dollar, and it's an interesting development that's unfolding. Because even the speculators are now turning against the dollar. And so if you have a look at this chart where we focus on the long and the short positions of the speculators in the market, they've turned negative. And they've turned negative in a way that we haven't seen in a very long time. So you'd have to go all the way back to the early 2020s to see that we've shifted to this kind of position, and the trade weighted dollar is kind of mimicking that move. I would not be surprised to see the net short position on the dollar build even more. But let's have a look at some of the reasons why. Well, we know, and this, by the way, relates to the question on gold. So one of the big themes that we have noticed unfolding since Donald Trump has taken over is that major central banks around the world, the major holders of US Treasuries, have been selling their US Treasuries. So slowly but surely, what we have found is that little bit by little bit, these central banks have decided that the U.S. policy making is not to be trusted in the way that it used to be. The transparency about how future U.S. policy will look like is becoming a bit confusing. And geopolitically speaking, Donald Trump has ruffled many feathers, and many countries have realized that perhaps it would be prudent to diversify themselves away from just US Treasuries. So they've been selling US Treasuries, and that's the blue line coming down. And you can see a very nice fit between the custody holdings of US Treasuries and how the dollar has performed. Now, the dollar has come down a little bit, but according to this chart, it probably has quite a lot more to slide. The question is, what are these central banks doing with their with the money that they are liquidating from the sale of those US Treasuries? At least one of the reasons, at least one of the destinations for that has actually been the gold price, has been the gold market. And you've had this enormous run up. So central banks have been selling US Treasuries and they've effectively been buying gold. And whether you look at China, whether you look at India, whether you look at Brazil and Russia, they've all been gradually building up their holdings of gold. And gradually, slowly but surely, they are weaning themselves off their dependency on US fiscal policy and US policymakers more generally. So whereas even Japan, by the way, has been selling US Treasuries. So whereas you used to have a country like China that held something in the order of about $1.3 trillion of US Treasuries, they now only hold 750 billion. But their holdings of gold have ramped up very significantly. And I think that is the reason why the gold price has been rallying as hard as it's rallied. And if anything, that is one more reason that I would put forward as to why the dollar probably needs to lose some ground. The gold price, yeah, maybe it's run a little bit too far in the very near term. But the reality is that it's being supported by gold demand. And, there are countries like South Africa that are not producing gold to the same extent as they used to. And so you've got constrained supply on the one hand, you've got this central banking demand on the other. And there is some speculation taking place that the BRICS currency, that the BRICS group of countries are looking to create their own digital currency that's going to be backed by a combination of oil and gold. So that's an interesting side dynamic that will unfold. I don't expect them to do much with announcing a currency while Donald Trump is in power, but watch what happens shortly after that. In the interim, they are busy buying up gold and making sure that BRICS Plus is a collection of oil-producing countries. If you've noticed, the UAE, Iran, Russia, Saudi are all now part of BRICS Plus. All your biggest oil producers in the world are now all collectively sitting in one collective. So again, sticking on the theme of commodities, we've got a very interesting chart on the left-hand side, which talks about the interplay between the dollar, the valuation of the dollar, which is the blue line. It's the previous charts that I showed you, versus a measure of commodities versus the S&P 500. What you would expect to see if the dollar is about to come down, you would expect to see the commodity prices heading back up. Now, it can happen one of two ways. Either commodity prices head higher, which would be generally quite supportive of the rand, or you could get a correction in the stock markets. Stock markets have run quite hard and maybe are due a bit of a correction. But as that happens, the indications are that the dollar is more likely to come under pressure than not. The chart on the right is specifically focusing on US exceptionalism and the fact that the US is losing that exceptionalism. its growth rates are okay for now, but there are a lot of indicators that the Fed is concerned about, and that investors are concerned about, that are pointing to a downturn. As those excess savings wind out of the system, maybe the US business cycle becomes a little more vulnerable to a downturn. Well, if you don't have the growth, and the Fed is busy cutting interest rates, and central banks are no longer going to be conducting quantitative tightening in the way that they are, potentially you should have a dollar that loses more ground. So moving on to some local charts, before we just touch on the Rand quickly. Just an update on the South African economy. Cyclically, which is the green line, doing a little bit better in buoyant territory. That's partly because the inflation rate has remained more subdued, so it's freed up disposable income, partly because we've had commodity prices that have done quite well, and that's supported the mining industry, and partly because we've had some interest rate cuts that have come through. A combination of all of that with some Rand resilience tends to boost the business cycle domestically, and so you've got that short-term signal that's moved into buoyant territory. Unfortunately, our structural indicator is still in challenging territory. It's moving in the right direction, but there's quite a long way to go, and more investment is required into this economy. As this chart clearly shows, our fixed investment as a percent of GDP is lagging and very disappointing. We need this line to be moving upwards. At the point where it's moving upwards, you will see it coincide with much stronger levels of growth, which is why we're looking with interest towards Cyril Ramaphosa to see whether or not he can get some of this investment going into the economy. Should he do so, a lot of South Africa's problems get resolved. And this is why we are so supportive of Operation Vulindlela, because finally the authorities appear to be leaning more heavily on the private sector, and so they should, because when you have a look at the fixed investment per sectors, you'll see that it's the private sector, the orange line, that has done most of the heavy lifting. The biggest detractors from fixed investments have been public corporations. Does that surprise you that the SOEs and the malfunctioning SOEs have done such damage, whilst general government isn't doing much better? So allow the private sector room to breathe and do what it wants to do. Liberalize some of these network industries like trains, like electricity, like ports, and watch some of that investment come back into the country and just be a little bit better off. But whilst we have some of those inefficiencies baked into the system, and whilst we have a reserve bank that's targeting a 3% preference and is adopting a more conservative approach to monetary policy, what that does mean for the Rand, at the very least, is that we creep up the rankings of our carry attractiveness. And so Rand is second from top in terms of our holistic carry attractiveness index. On the left-hand chart, you'll see the Rand versus the emerging market average versus the developed market average, and we're doing substantially better than that. Interesting, if you have a look at the right-hand chart, the ladder, and you look at the last four currencies, you'll find that they contain the dollar, the euro, and the pound, which tends to suggest that Rand, by rights, on this analysis, should perform reasonably well. In terms of its performance versus other emerging markets, well, it's kind of like a little bit above average. It's the fourth best performing currency this year, and that's despite some of the issues that we've had with on the fiscal side and very weak growth. So from that perspective, I think the Rand's done about as well as it could have done. Maybe it will still do a little bit more, because we still have very strong commodity terms of trade. As you see from the chart on the right, this is very supportive of Rand over the longer term. So when we have a look at our valuation, where does that place us? Well, the interesting bit is that it places us now at levels that are more supportive of importers covering forward, importers taking advantage of these levels and covering forward. So what we've got on the left-hand side is a chart versus our central tendency. So this is a statistical model with deviations away from that central tendency. where the closer you are to the fringes of each one of these ranges, the easier it is to make a call as to what you should be doing as part of your hedging strategy. Where we are right now, it's telling us that this is closer to a sweet spot for importers than it is for exporters. You attach the forward points onto that, and you can cover forward to levels just under $18 to the dollar a year from now, which we think raises the probability that as an importer you will beat the prevailing spot rate at that point in time. It's not a guarantee, but we think that the probability tilts in your favor as an importer. The chart on the right just gives you a sense of if the rand had to strengthen a lot further, what would be the extreme edge of that move? And the extreme edge of that move would be something approaching $16 to the dollar. That would be a very significant move if it were to happen. We still think that there's more left in what we're seeing at the moment, and that levels back below 17 rand to the dollar are possible. But we're starting to build the argument for why importers should be taking advantage of these levels and of this environment at the moment, because it is moving in their favor. And then finally, before ending off, just an update on our rand sentiment indicator. Well, it's remaining neutral to buoyant, and again just feeds into that general expectation that rand should perform reasonably well and prove resilient through the course of the next 6 to 9 months. And that would be good news for South Africa. It helps reduce our inflation rate, which then helps the SARB reduce interest rates. It also means that we have some stability that comes through for corporate budgeting and planning, which always tends to help GDP growth at the margin. So all in all, slightly upbeat perspective on the prospects for the rand, and why, and gives you a little bit of a backdrop to what's going on internationally. The biggest risk to all of this is that there is a major correction in stock markets internationally, and that ultimately that risk element in the market rises again and people rotate away from emerging markets. But at the moment, and this is the interesting dynamic that has changed and which does make this time a little bit different, is that the world is starting to look at the developed market economies a little differently. They're starting to see inherent risk baked into those economies, and so they're no longer the obvious default to just shift your funds straight into those currencies. Although, in an extreme case, that is probably what they would do. But in this environment where GDP growth is holding up, where stock markets are holding up, rand is likely to perform well. And like I said, importers are more in the sweet spot to take advantage. And Richard, that brings me to the end of the presentation. So happy to take any questions.
George, I've got a question. So volatility. Okay, dollar rand volatility, euro rand volatility, the VIX. Volatility is heading to sort of all-time lows. Dollar rand volatility is like at a 14-year low. Euro rand volatility is actually lower than euro dollar volatility at this stage. I think, and I've been in the markets for 20 years, I don't think I've ever seen a rand cross pair's volatility lower than the world's major currency pair. You talked about the recession in the US just being around the corner. Are we heading for a volatility event is there a volatility event around the corner?
Yeah, so I think that's possible, Richard. It does bother me that they're as low as they are. Look, you kind of expect that when you've got a low inflation environment, when you're running a trade surplus, when your fundamentals like your terms of trade are in your favor, when your interest rates are higher than most countries around the world, and you rank right up at the top of a carry attractiveness index. So for all of these reasons, the volatility is lower. What we're also finding, and this is less positive, is that due to South Africa slipping to sub-investment grade and being on the grey list for as long as we've been, the amount of hot money flows that South Africa attracts has decreased significantly, and you can see that in the SARB's turnover numbers. So the SARB's turnover numbers show that there's been a subsidence of those hot money flows, And as a result of that, you've just got less foreign interest in South African markets than was the case previously. Now, that may change if South Africa gets off the grey list, for example,
Sorry,
and
can I
you start
just
getting
interrupt you
some...
quickly? Can I quickly
yeah.
interrupt you? But if you look at 5-year credit default swaps and our foreign risk bond premiums, that's at like 7-year lows at this stage as well. So
Yes.
I won't be like volatility is low. You mentioned all those positives. And you just mentioned if we get off the grey list, isn't that aren't we ripe for more money coming into this country and supporting the rand even further?
Initially, yes, but the minute you have more hot money coming in, you also have the potential for more hot money coming back out. So that might be a bit of a game changer in terms of volatility down the line. But for now, the stars are aligning for rand to remain strong, if not go a little bit stronger. But yes, it comes with a big caveat, and that caveat is whether or not this Goldilocks environment in the global financial markets can withstand all of these developments for a little bit longer. So I would be a little bit concerned about the volatility. I do think it feels a little bit too low for a country like South Africa, which is an emerging market filled with all sorts of political and social and structural economic problems. So you would anticipate that over time that does start to pick up again. But for now, the world and investors are distracted by all sorts of things that are going on abroad. So that's one positive thing that Donald Trump has brought, is that he's diverted everybody's attention to what's happening in the US, the UK, Europe, Japan, China, Russia, Middle East with Israel and Iran. Yeah, and people are just paying less attention to emerging markets like South Africa at the moment. I mean, yeah, it's just it's a blessing and it's a curse all rolled into one. You would prefer to be more integrated into the global economy and lots of people participating in the domestic economy, but you know that when that happens, the potential exists for them to be able to withdraw it should we make any missteps, and South Africa is pretty good at making missteps.
We've got a political question, the risk of possibly move from the NEC at the end of the year. What will happen? What will that impact have on the rand?
Yeah, that is a big risk. That's a very good point to raise, Philip. It is a big risk because at this point in time, and we've had some discussions with political analysts, and it's unclear who would replace him. The candidates that are available, some of them are heavily compromised as well. So that's not a great outcome. Offsetting that to some degree would be if the ANC lost more power in the municipal elections. In these municipal elections, if the ANC drops significantly further, and the indications are that the likes of COSATU and Labour are not going to just default straight towards voting ANC, then the ANC becomes less of a factor going forward, and those kinds of leadership changes in the future might not be as significant as they have been historically. So let's not forget that we are in a GNU now. The ANC doesn't just get its own way whenever it wants. Yes, it has a dominant force in that GNU, but as we've seen over the course of the past year, they don't get to just dictate terms as they used to, and that is a substantial shift. So, going forward, I think that is a risk, Philip, and you're right to mention it. It has the potential to spark some volatility, and mostly because we don't know who would replace him. So that is something to keep an eye out for, and has the potential to impact volatility for sure.
Then the next question is there a risk of exclusion from the SWIFT system built into the current rand valuation levels?
No, absolutely not, and we don't see that as a realistic prospect at this point. I don't think that the sanctions would go that far on South Africa. We don't see it. What we have seen and what we have picked up is that any sanctions that get imposed on South Africa are going to be more targeted. So there's a real recognition that the wrongdoers are are housed within the ANC rather than, generally speaking, the population of South Africa. So the issues that the likes of the US, for example, has with South Africa is more specifically related to a party than it is to the country more broadly. And that's where I know that there's a lot of pressure brought on the likes of AfriForum and others that make their way over the pond to go and speak to their US counterparts, but they have made that point repeatedly. They've made the point repeatedly that this isn't necessarily a South Africa problem, that this is an ANC problem. And so we think that if there's any sanctions that are going to be brought, that are going to be leveled, that they are going to be leveled on the ANC rather than on South Africa more broadly.
And then just lastly, George, because I've read it in the news, is and this morning it came up on Bloomberg, is Parkstyle said they had good negotiations with the US trade people. And do we expect that we probably have a different trade deal on the table than we currently have with the US, or is it all things being equal at the moment?
Yeah, I think they have, from what I've picked up, they have sharpened their pencil, and they have gone back to the US with something that's a little more acceptable to the US and is a little more ambitious, as Trump asked for the trade deal to become. I think we went in very half-baked the first time. I still do not fully understand what Ramaphosa's mission over there was, other than to purposely take one for the team, eat a bit of humble pie in the hope that it softens the US's stance towards South Africa. I mean, it didn't work. So what they needed to go back to was a decent trade deal, and they've been working on that in the background. And yes, there may be a little bit of pressure that comes off as a result of an improved trade deal. Let's hope. Unfortunately, I don't have insight into those halls of power. I can only pick up what I see in the news. But from the reports that I saw this morning, it is looking a little more constructive, and let's hope that is the case.
Okay, so George, just in summary, so inflation, interest rates, US tariffs is still top of mind, but at the moment it just feels like everything is just grinding to a halt until something probably is going to explode. Is that the right analysis that I'm getting here?
Yeah, well, the thing with tariffs is that we're waiting because the courts have ruled that they're illegal and Trump is appealing it, and I think that gets heard in November. So we're in limbo until that on the issue of tariffs. Equally, his influence on the Fed and who's going to be voting there is with the courts as well. In the interim, domestically, we're still waiting for the Department of Finance and the Reserve Bank to officially change the inflation target to 3%. So we kind of a little bit in limbo there too. At the same time, you've got wars that continue to unfold and that there seems to be no end to. So there's a lot in limbo. So your analogy is not far wrong, Vichard. The more things change, the more they seem to stay the same. In the absence of any convincing shift in policies or economic developments, people are kind of sitting on their hands and saying, well, let's wait for the dust to settle before we adopt any substantial position. You're kind of seeing that in the rand at the moment as well. It has ground a little bit into a range and is not adopting any clear directional momentum. And I think that probably stands to reason. It's very difficult to take very firm views at the moment, one way or another, just because there's so much that's awaiting approval or awaiting a court outcome or awaiting a shift. And so it's tricky. But, the best advice I could give people is just take the data month by month as it comes. Just pay attention to our podcasts, our webinars. We'll keep you guys abreast of any developments as they happen. And if something dramatic happens, Vichard will be on the phone with me pretty quickly to say, hey, George, I think we need to cover this. and I'll give him the thumbs up, and we'll let you guys know of how things are unfolding. But yeah, Vichard, I think you summed it up reasonably well.
Thanks for that, George. Yeah, so everybody, thanks for attending. We still see weaker dollar going forward. We still have our numbers. We'll still be in contact. We'll send us out to everybody, and enjoy the weekend that lies ahead, and we'll be in contact soon. Thanks, George.
Thanks, everybody. Have a good weekend.